Business credit is one of the most misunderstood tools in modern finance. To some people, it looks like opportunity, access to capital, higher limits, leverage without using personal money. And on the surface, that sounds powerful. But the problem isn't credit. The problem is how people interpret it. Because credit doesn't create wealth. Credit magnifies whatever system already exists. If the system is stable, credit can accelerate growth. If the system is fragile, credit accelerates collapse. And most people, they don't realize which one they're holding. The common belief is simple. Business credit equals free money. Well, not technically free, of course, but easy, flexible, something that can help you move faster. So, people chase approvals, higher limits, more cards, more lines. The focus becomes access, not structure. And access without structure is dangerous, because credit does not solve weak financial systems. It exposes them. A business with poor cash flow does not improve with more credit. It becomes more fragile. And the same is true for individuals. To understand credit, we need to separate three things: access, control, and structure. Access simply means you're allowed to borrow. That's it. It doesn't mean the money is productive. It doesn't mean the system can handle it. And it certainly doesn't mean the outcome will be positive. Credit only becomes powerful when it sits inside of a controlled structure. A stable financial system usually has three characteristics: predictable cash flow, controlled expenses, and clear asset accumulation. When those three exist, credit becomes a tool, not a lifeline. Without them, credit becomes a delay mechanism. It only postpones problems instead of solving them. And delayed problems tend to grow. Credit is borrowed purchasing power. Cash is what you already own. Credit is temporarily borrowed. And assets produce return, while debt amplifies outcome. If borrowed money supports a productive asset, credit can multiply growth. If borrowed money supports consumption, credit multiplies frugality. That's the difference. When credit is misunderstood, the pattern is predictable. Expansion comes first, structure comes later. People open accounts before stabilizing income. They borrow before controlling expenses. They scale before building durability. And in short term, it can feel like progress. Maybe even new opportunities appear. Purchases feel easier. Movement feels faster. But speed hides structural weakness. If revenue slows, if expenses rise, if risk compounds, the system begins to strain. And credit, which once looked like opportunity, becomes pressure. Minimum payments increase. Interest compounds. And flexibility just disappears. See, the amplifier, it works in both directions. Rule number 3. Credit amplifies structure. Credit amplifies structure. If your financial system is disciplined, credit accelerates growth. But if your financial system is unstable, credit accelerates failure. So the question is never, how much credit can I access? The real question is, what is my system capable of supporting? Access is easy. Stability is harder. But stability determines the outcome. People who build durable wealth treat credit differently. They don't chase it. They prepare for it. They stabilize cash flow. They control spending. They build reserves. Only after those foundations exist do they introduce leverage. Because to them, credit is not opportunity. It's responsibility. An amplifier deserves discipline. In the next episode, we're going to look at something that quietly destroys more financial systems than credit ever could. Breaking your own system. Because most financial failure doesn't happen because people lack information. It happens because they abandon structure the moment things start working. And once you see how that pattern works, you'll start protecting your system instead of consistently rebuilding it. That's what we'll break down next.